Muthukumar S asks, how should one follow a core and satellite approach for the debt fund portfolio?
First of all, a core and a satellite approach, as the name suggests, is where you essentially build your portfolio with two components, a core component and the satellite component. And the core is typically the mainstay of one's portfolio. So for a core holding, the kind of tenets one should look for are these are the kind of investments where you don't essentially take much more risk than the overall risk that is inherent in that asset class. And here you would want to remain by and large well diversified, keep your risks under control, and you would hope to beat the market by a little bit. Or for those who are opting for a passive strategy for their core, they would like to match the market in terms of returns. Now, for the satellites, these are small supplementary or tactical allocations, which may be slightly higher on risk and which have uh, a better return potential over the long term. So because of the high risks, you don't want to go overboard with these kind of allocations, but you want to add them in a measured dose to boost your overall returns. So that is the overall concept of building a core and a satellite approach for your investments. And it is possible to implement something similar with your debt allocation as well. So in the debt for your core, you would want investments which are well diversified, which do not take a lot of credit risk by investing too much in bonds of lower rated issuers. These are the kind of investments which also keep the interest rate fairly under check by not going overboard on bonds which come with a very high maturity or a very long duration. And overall, they combine and they construct a portfolio by combining, say, corporate bonds or GSECs in a way that the portfolio almost always remains fairly well on liquidity. So these are the kind of tenets that you want to achieve from your core debt allocation. And we believe that these are the kind of tenets that one gets from short duration funds. So we believe that short duration funds fit the bill to form the core of a fixed income portfolio. Now, for the satellite allocation, these could be the instruments or the funds where one may want to assume slightly higher credit risk by investing in funds which take aggressive credit calls, or they can assume a little bit of interest rate risk by investing in funds which invest in longer dated papers, because these are the kind of two strategies: either you assume a little bit of credit risk or you go long on duration, and this is how you can derive some extra yield. Now, on the credit risk side, of course, there are credit risk funds which one may want to add in a small supplementary allocation, or on the duration side, one can look at funds like the gilt funds or the dynamic bond funds, or some other medium to long duration categories of funds. But again, I'll reiterate that for a vast majority of investors, they have a very low tolerance for risk in their fixed income portfolios, and they don't like a lot of volatility. So for a vast majority of investors, it may just be suitable to stick to the core allocations and give a skip to the supplementary allocations altogether. And with their core allocation, they can aim to achieve returns which are slightly better than what a bank FD could fetch, and that should be good enough.